Hello, everyone, and thank you so much for joining us for our quarterly investment commentary webinar. I'm Margaret Sargent, Senior Marketing Associate here at New Frontier, and I am very pleased to be joined today by our President and CEO, Dr. Richard Michaud, our CIO, Robert Michaud, and Research Analyst, Joy Zhang. Robert will be kicking off today's webinar with an overview of New Frontier's investment philosophy and process. That should run about 10 minutes. And then Joy will be sharing a review of the quarterly performance for both our portfolios and the broader market. That should be about 5 minutes. Then Dr. Michaud will share a discussion of his quarterly market perspectives for about 20 minutes, and we'll have some time for questions and answers at the end, as well as a couple of notes from marketing. Now, just a quick housekeeping note before we begin. Your lines will be muted for the duration of the call to reduce background noise. So if you do have any questions, please submit those using the chat feature of GoToWebinar. And without further ado, I will pass things over to Robert.
Great. Thank you, Margaret. So I'd like to start with our investment philosophy and process, because that is really the foundation of everything we do, and that's the key to understanding our performance, not just over the past quarter, but our performance over long periods of time too. And you can see here we're quite proud of our nearly 15-year track record, and I rounded down there, so by the end of this presentation it might be almost 14.97 years of our track record, but this is something obviously that's significant. Is we've been there since almost the beginning of the ETF era, and we've had, and I think a lot of our success is based on our focus on the ideas that we started the firm on, the ideas that we published and patented, the ideas that are the basis of our technology that we've been developing for the better part of 2 decades, and that we continue to innovate on. Now. So you can see that we're continuing to do research, we're continuing to publish papers, and that's an important part of what we have done and what we continue to do. So this focus on ideas, how does it fit in to our investment portfolio? So we have 15 investment portfolios. These are risk-targeted portfolios from 20% equity, 80% fixed income, all the way up to 100% equity. Our standard and tax-sensitive portfolios have been there from the beginning. The multi-asset income were launched in 2012. And these are all managed by the same overriding investment process. The same ideas, the same technology, the same capital market assumptions go into all of them, but they are all built for very different investment objectives. And so whether the investment objective is for total return optimization, for the optimizing the wealth that you keep after taxes, or building sustainable, reliable, and growing income through our multi-asset income portfolios, very different portfolios based on these objectives. Also, it's important to remember that a conservative portfolio is a very different objective than an aggressive portfolio. Now, our investment process is the cornerstone of what we do, and it's been consistent but evolving over the last 15 years. And to start with how we think about assets, we're an independent ETF manager. We pick what we think are the most appropriate ETFs, regardless of which fund family they come from. And they're usually there because they either have a unique risk characteristic, a risk premium that they're trying to capture, or some sort of diversifying property, low correlation that helps reduce risk in the portfolio. In terms of how we think about capital market expectations, this is where we call ourselves strategic but not static. This is where we take the best information available from historical data, current market information, and economic theory, combine them in a mathematically consistent framework so that we are up to date. We're using really all the available information that's reliable and building up-to-date expectations of what is the market is saying the risk and return opportunities are available today. And then we'll optimize these portfolios. And to start with how we optimize, first we'll say how we don't optimize the portfolios. What we don't do is we don't just take some set of bonds, some set of stocks, and then connect the dots in between. So from our perspective, this is deficient in 2 very important ways. So the first is whatever happened to Markowitz's Nobel Prize-winning theory of every investor should be trying to maximize return, minimize risk, build really well-diversified portfolios that are fundamentally different for different investment objectives. And this is important because just by doing portfolio construction well, you can improve risk-adjusted return in portfolios and add value for your investors. Now, a 15-year track record is helpful, but I like to not just say we're doing things well, but actually demonstrate that we're doing things well. And so in addition to having good performance, we want to show that these portfolios have intuitively the right properties. And I think this is one of my favorite examples to demonstrate that. So here we have blown up the bond portfolio portion of a conservative and an aggressive portfolio. And now it's always about the whole portfolio and how the whole portfolio behaves. But for this example, I'm just going to show you what the bonds look like. And over here, you can see in a conservative portfolio, this light blue color is short-term treasuries. There's intermediate treasuries in orange and a lot of also mortgages in the light blue. And so these are sort of intuitively what should be inside a conservative portfolio. You should not be having a lot of bonds, but bonds with lots of risk. You want to have the portfolio managing all the risk factors, credit, duration risk, as well as the equity risks in the portfolio. Now, if you switch to a more aggressive portfolio or a 75-25 portfolio, you'll see that short-term treasuries have completely disappeared. Mortgages are very small, and you have much more longer-term, longer duration bonds, exposure to emerging markets, equities, and high yield. And so now the bonds of the portfolio are doing two things. They're trying to diversify some of the equity risk, and they're also trying to aggressively go after the bond risk premia that are available. So how do you do optimization well? Unfortunately, Markowitz's theory didn't work out as well. People have heard of lots of problems with modern portfolio theory. And the big idea that we founded our company on was a way to improve modern portfolio theory and really do optimization much better, which allows us to build these well-diversified portfolios. And so we have patents on this, and this is a big part of our book. And the main idea here is that Markowitz optimization was very sensitive to errors in your forecasts and generally was very backward-looking. And instead of betting everything on one very specific version of the future, we actually look at thousands of different ways markets can perform, and we build a portfolio that's well-diversified and optimal amongst those thousands of scenarios. And so this is really a new efficient frontier. It's much better diversified, and it incorporates all sorts of different views on risks and risk premia. And importantly, Markowitz did independent research, and his independent research found that it actually works pretty well. So this is another thing that we're quite proud of, and a good demonstration of why over the last 15 years our portfolios continue to do well. So the last part of our investment process is rebalancing. And so we have a dynamic investment process. We build an entire efficient frontier. We pick a risk-targeted portfolio, and then we optimize to it. We trade to that. And over time, prices change, and the portfolio is no longer optimal. Also, over time, information changes, and the whole efficient frontier changes, and our optimal portfolios along with it. And we need to ask ourselves every day. We have built a process that every day looks at all this data, looks at thousands of different scenarios, and then can calculate what percentage of the time do we think the portfolios are likely to benefit from trading. So this fits in well with many things that we do, which is being aware of a constantly evolving world, being a strategic manager, but also paying attention that the world is changing and we don't know when the portfolios are going to need to be rebalanced. It's not just every January. And this has led to us rebalancing between 1 and 3 times a year over the history of these portfolios. And so when we do find that the whole portfolio characteristics will benefit the investor to rebalance, that's when we trade the portfolios. And this is sort of the final piece of our investment technology, and this is something that we run on a daily basis. Our investment committee will meet in Boston at least every week, but of course we don't trade the portfolios, but we do make sure that they always have the right risk characteristics. So that's really what I wanted to talk about. The things that people keep in mind is that we may be strategic asset managers, but we're not static. Everything is based on evidence. We look at data. but we always want to adapt to the market when it changes. We have a process that follows the institutional process of not being fickle, being conservative, don't want to make any take any bets or invest in any risks that are not likely to pay off in the investors' interest. And then we really want to focus on asset allocation, on our process, and on the technology that we think is reliable. So with that, I will bring it over to Joy, who will talk about some of the issues that are going on that have led to our performance.
Thank you, Robert, for the great overview of the investment process. Now let's switch to performance. So first of all, we have New Frontier Index performance in front of us. The indices are Michaud-optimized global indices, which are constructed and rebalanced through the same investment process Robert talked about. And look at the performance. Here we have light blue and dark blue, which represent the indices quarterly and year-to-date performance. In yellow and black, we have benchmark quarterly and year-to-date performance. It has been a really good quarter and a fantastic year across the board. And more exciting, almost all our indices have reached all-time highs, especially lower and moderate risk level indices have done extremely well, dramatically outperforming benchmarks, as you can see here. One exception is index, the all equity index, NFGEI, which is basically in line with the benchmark. And the same happy story continues for our Texas portfolios. Again, great quarter, great year. And more good news coming from multi-asset income portfolios. I can never talk enough about their actual performance. They have done really well as far back as I can remember. They not only have consistent positive returns, but also having primary objective of providing sustainable, stable yield, which is about 4% at this moment. So that was the performance of our portfolios. Now let's look at performance of each asset class that have contributed to that. So first on equity. Again, it has been a great year for global equities. However, in this quarter, we have seen that global equities were virtually flat, which makes it easier to see what were the contributors this year. No surprise, U.S. equities were excellent this quarter, especially U.S. large cap, U.S. low vol, and the U.S. real estate are doing a fantastic job. Small cap, including U.S. small cap and international small cap, are slightly underperforming, as well as some risky equities like emerging markets in China have hurt our performance. So it does explain most of the reasons why the performance of the most aggressive portfolios is not that much higher than the performance of less aggressive portfolios. And one thing I want to point out here for our multi-asset income portfolios is that the income-producing equities like U.S. dividend, U.S. REITs, and U.S. preferreds are doing really well, contributing to the consistent performance. Now let's move to fixed income side. Again, great year, great quarter for bonds in general. But this year, the spotlight is definitely on duration. No surprise, long treasuries, long corporates are leading the way, with other bonds pretty much performed in line with their duration exposure. Two exceptions. Here, international treasuries, which suffered from rising dollars, and high yield with surprisingly mediocre performance in an up market quarter. As far as our asset allocation changes, we rebalanced multi-asset income portfolios in August with the latest market information, including term structure of interest rates and yields. This also represents the third and final implementation of our latest research on mutual efficient frontiers. So the resulting portfolio is always more optimal than previous one, with higher expected yield and lower anticipated volatility through risk management. We saw modest shifts to mortgage, credit, and U.S. large cap dividend-paying equities, fund treasuries, international stocks, and rates. So one specific change I want to point out here is that we make a transition to new preferred stock ETF that has preferable risk characteristics, lower expense ratio, and higher yield, which we believe will benefit our clients. So the last thing I want to show you here is a graph that everyone has been talking about this quarter. The observation people make out of this graph is that an inverted yield curve has predicted the past recessions. However, here in New Frontier, we don't bet, nor do we predict the future recessions. With this in mind, I'll pass it over to Dick, who will talk about what future falls going forward. Thank you.
Thank you very much, Joy, for making that presentation on a performance review. So now my purpose is to talk about our market perspectives. So let me begin and do that. Way to go. Okay, so the market perspectives is on the website. The title of this quarter's perspective is Economics in the Time of Twitter. So let me just give you a quick overview. It was a great year to invest. We want to talk about the Fed, we want to talk about the Repo Spike, and we, of course, need to talk about the European Central Bank policies, bonds, quant factor funds, China, gold, a number of issues associated with what's going on in this quarter and this year. Then we want to look ahead just quickly, impeachment, inquiry, index fund milestone, and some research announcements. It was a great year for investors, right? The global economic slowdown and geopolitical turmoil made super safe assets really attractive. The AG was 8.5%. Gold was 16%. Amazing, 16%. Long-term treasuries, everybody's worried about long-term treasuries and duration. It's a great bet, 20%, and REITs were 25%. And of course, the U.S. economy has been terrific. So the S&P 500 has been an index up to 21%. Long-term trends continued throughout the quarter, pretty much. International underperforming domestic, value underperforming growth. But it was a volatile quarter as well, and it was kind of an interesting quarter. But the S&P was up only a modest 1.2%. And for a short while, people thought that value was going to turn and outperform growth, but it did not. It wasn't sustainable. So the Fed, the mid-September meeting, as I think we all remember, interest rate cut was very uncertain. We had a robust U.S. economy, so we had low unemployment, strong consumer activity, steady growth rate, manageable inflation, wide cut interest rates. On the other hand, we had a U.S.-China trade war, slowing global growth, a concern with the crossover in yield curves, and then, of course, we had presidential John voting for more rate cuts to support his re-election campaign. So the Fed ended up by cutting the Fed funds rate a 0.25%. Was it pure economics? Or was it political influence? No clear guidance associated with the minutes of the Fed meeting. They're threading a needle, right? They've been trying to balance economic and political factors. On the one hand, business confidence has fallen for the sixth consecutive quarter. Geopolitical uncertainty has definitely taken hold. Nobody wants to kill the 10-year economic expansion, but on the other hand, leaving rates as they are gives the Fed headroom for action if the new risk arises, and further cuts of low rates may have very little impact. It's something to think about. And then there are the political issues of urgency. The presidential election is only a year away. A recession could be a very serious problem for the president's re-election. So there's plenty of pressure to supercharge growth, and it would be very desirable from a purely political perspective. And then there's the trade war and also the deficit. Now, the trade war is going to be a fixture for some time to come. I personally do not believe the trade war will end until Mr. Trump is no longer president. So the trade policy is negative on global economic growth. That's just an axiom of modern economics. It's not possible for it to be anything else. There is a decline in sentiment and of shareholder, customer, supplier, worker, community sentiment currently. And then the deficit. We don't want to forget the deficit. It's topped $1 trillion in the first 11 months of the fiscal year this year. And the government spending climbed 7%. Tax receipts grew 3%. So some more deficits. Deficits were growing at this rate. We were climbing out of the Great Recession. So there's no deficit reduction policy right now. While rate costs for servicing debt are near historic lows, it would be a great time to actually think about reducing their debt. But anyway. And then during the quarter, there was something called a repo spike. It was a short-lived spike in the Fed repo rate during the quarter. The Fed funds rate was just pushed too high for a day. Now, the Federal Reserve of New York has the responsibility of intervening, and they supplied some liquidity to make sure the Fed policy range was in the way it was supposed to be. Now, repo rates can surge when banks trim balance sheets for regulatory purposes near the end of the quarter, but this time the spike came 2 weeks before quarter end. So there was a lot of concern. About the repo spike. The Fed conceded that bank reserve levels may have been too low. The consequence of paring back the Fed's balance sheet, and the Fed is now planning on increasing its reserves, but the people were concerned. Is the Fed doing what it thinks it's doing? But if you think things are tough here in the United States, you might want to look across the pond. Dr. Draghi is the outgoing ECB president. He is, by every definition, a genius in monetary economics. He cut the deposit rate by 0.1% to minus 0.5%. Think about that. Minus 0.5% for the Eurozone. He restarted QE with the Eurobond buying policy, and he instituted a dual rate policy for banks. So he basically is giving banks money for them to lend, and they are guaranteed a profit. But of course, it's only for banks that qualify for the program. He's trying to encourage good banks to be active in lending. But this is really an unusual situation. And then Draghi won the Eurozone. The economic growth is likely to lag. He blames political uncertainty for not reaching goals. His mandate is doing whatever it takes to hit the inflation target. And he claims no other policy alternatives for saving the euro and reviving the economy. So it's really quite dire. The dual rate policy essentially means that the ECB is out of monetary ammunition. The only real solution, as every good macroeconomics economist would say, is that the Eurozone countries that can should spend more and cut taxes. But it's a really serious issue going on in Europe because cheap loans the answer for reviving Europe. Companies attend more to opportunities than borrowing costs. And investing capital with failing wages and austerity policies is not a great time to be thinking about growing the firm. And the European economy is absent of dynamic technologies. Oh, by the way, President Trump is threatening tariffs. Cutting rates viewed as weakening the euro, requiring retaliatory tariffs. So it's a serious issue. Draghi's announcement drew very fierce criticism. 7 of the 25 members of the ECB opposed Draghi's plans. That's an unusual situation. The measures were called ineffective. We're penalizing people who save. We're fueling asset bubbles. The ECB was accused of stealing German savers' money. Pretty severe. The Draghi policies conflict with elected government policies as well. The ECB is seen as subsidizing spendthrift governments like Italy, who are being spared the painful process of refining their economy. So this leaves the new ECB president, Christine Lagarde, something of a tough row to hoe here. She has slowing growth, trade dispute vulnerability, low inflation, limited room for policy changes, but except for that, everything's wonderful, right? The Eurozone has very serious challenges near term. We want to think about all of that and the implications for investing. And I'm very sure Ms. Lagarde would want to change places with Mr. Powell. A 3-decade bond bull market is ending. Well, some people thought so. Early to mid-September, the 10-year Treasury yields rose from a record low of 1.47% on the 4th of September to 1.9%, excuse me, on the 13th of September to 1.52 on the 4th of October to 1.77 roughly what it is now. The bond yield went from minus 0.7 to minus 0.45. The 10-year gilt went from 0.48% to 0.676% before going back to 0.49%. Talk about being whipsawed. Talk about an incredibly volatile time for bond managers. It must have been something totally without experience in living his memory of most bond managers. The bond market lost over $1 trillion in 10 trading sessions. You know, that's money, $1 trillion, and saw a reduction of $3 trillion of negative yielding bonds. So the big issue is all of this a pause or a reversal? And bond yield declines are not inevitable. A great deal of uncertainty concerning the direction of yield, right? And the bottom may not have been seen yet. And what about corporate and junk bond issues? U.S. companies have continue to borrow a lot of money. Domestic non-financial companies have borrowed nearly $10 trillion in debt, an increase of $1.2 trillion 2 years ago. But U.S. companies are healthy, so the borrowing rise may or may not be just nothing more than taking advantage of a low-rate environment. And percent of junk bonds we need to think about as well. It jumped from, and the percent of junk bonds with more than a 10% yield jumped from 6 to almost 10%. And investors have been pulling out of money, $6 billion from junk bond mutual funds and ETFs, and put about $19 billion into investment-grade corporate bond funds. So there's been a lot of moving parts in the bond world, all things that are important for long-term investing. Now let me switch gears here. It's also been a whipsaw month for many people, the quant factor funds in particular. September was a painful month for many computer-driven hedge and factor funds. The quant models were caught with a sharp reversal of a number of long-term trends. Managed futures funds have been betting heavily on a continuing rally in government bonds. That must have been quite a time. And for hedge and factor funds, there was a double whammy of selling off the factors and with rising yields. Chinese retrenchment is another important factor that's going on in global capital markets. Chinese companies have shed $40 billion in U.S. investments as a reflection of the souring U.S.-China trade relationships. And yuan is not the primary currency that the PBOC wanted it to be. Yuan is failing as a core element of international exchange relative to the dollar. International skepticism of managed convertible policies associated with the People's Bank of China and a decelerating economy have reduced interest in the yuan. Now, one of the more interesting positive things, however, has to do with gold. Gold was a 16% year to date, a very pleasant surprise for a non-equity ETF. A welcome, safe asset in global economic uncertainty. Well, we are investors in gold, of course, and of course, I'd love to tell you that we had forecast that, but of course, we haven't. What gold is just really a security that's important for risk management of the portfolios. But it has turned out to be a more useful countercyclical fear index for the VIX in this period. And gold has participated in the China-Hong Kong political turmoil because of China's confiscatory financial policies. Many people, foreign investors, are moving their gold holdings out of Hong Kong to Singapore and Switzerland. So let's look ahead for just a little. A financial history perspective is often pretty useful. 2007-2008 Great Recession included many economic issues, of course, but the central cause was out of control over-leveraging strategies, many large financial institutions, and also, of course, for regulation issues. So in the current geopolitical climate, there are a number of things. Drone attacks, price shocks, sharp bond yield changes, the trade war, domestic and international political turmoil. It's not really a common thread in many cases here. So for now, China tariff accommodations have reduced global tensions, but domestic political risk remains at a very high level. So just a quick note on the impeachment inquiry, because I think it's absolutely necessary to think about it. The impeachment process of President Trump is now in full gear. Fundamentally changes the narrative of the 2020 presidential election. That's just have to accept that. The president had 800 tweets in September, 500 more than he has in a normal month. So it's been a volatile time. There is a high uncertainty for a wide range of legislative and political initiatives, and the outcome is totally impossible to predict. Political issues like these will dominate the headlines until the 2020 election, but those of us thinking in terms of investing for investors, we want to remember economics may matter more, and stay diversified. So let me end my perspective here with a couple of additional issues. Morningstar announced that the index funds had reached a milestone. The equity index funds had more assets than active funds. In the past decade, 14 trillion net flows to U.S. index mutual funds and ETFs, 1.32 trillion fled higher costing actively managed funds. This has been a long time coming, said Jack Bogle. Low-cost index funds often outperform high-cost active funds. In 2008, a period when advisors were losing money, the high-price active did not protect in the downturn, creating great investor disillusionment of active strategies that persist even today. More than 80% of active funds underperformed the S&P composite in the decade ending 2018. Compelling evidence for requiring fee justification. But can't go too far. Okay, index funds are not a universal panacea. At some point, active investing is necessary for a well-functioning capital market. And a pure index fund management is fundamentally too passive. You want a professional manager, to attend to your savings. No one attending to investor savings is not an optimal solution. So what is required is a cost-justifiable, professional, active passive management that features low-cost, low-risk, high-quality investments, such as index tracking ETFs. And this is our recommended solution. New Frontier has pioneered low-fee, active passive ETF solutions for the last 15 years, exactly in this framework. And one last thing to say, Journal Investing has accepted the Michaud paper on estimation error and the fundamental law of active management for publication. So what does this mean? It actually means a lot for many of you, in spite of the fact that it might seem awfully obscure. Okay? The paper is a fundamental challenge to the orthodoxy of quantitative asset management technology, typically based on the Grinnell, the fundamental law of active management, that it has largely characterized asset management technology, active investment technology, that has also failed institutional or retail investors for more than 20 years. This is an important paper. Our view is effective, cost-efficient technology is the key to cost-justifiable active management for the future. So with that, I will turn it back to Margaret Sargent, and we'll look for questions, and she will continue.
Great, thanks, Dick. Just as a quick reminder, your lines are muted, so if you do have any questions, please submit those using the chat feature of GoToWebinar. And we can start with a couple questions that have already come in. So the first is, if Dick or Robert, I don't know which of you would like to field this, but do you want to talk a little bit about New Frontier's approach to cap-weighted versus non-cap-weighted ETFs?
Sure. So one thing to think about is, in terms of cap-weighted and non-cap-weighted ETFs, is to first sort of separate out the types of ETFs you're thinking of, whether you're thinking of a fixed income, a bond ETF, or an equity ETF. And I think, as Dick has said on a number of these webinars, is that there's no such thing as a true cap-weighted fixed income ETF. ETFs need to be liquid and they need to be able to trade in securities that are there. And the way I think of fixed income ETFs is what types of risk exposures are they capturing? There's a great deal of transparency for Treasury ETFs, and whether they're short, intermediate, or long term, they can very precisely deliver the type of duration and interest rate exposure that they are designed to do. On the corporate bonds and high yield bonds, those are much less of thinking about, you kind of have to throw the concept of representing the whole market out the window when you're over there, and just make sure the portfolio is liquid and generally behaves how it should. And that's what we're looking for on the fixed income side. On the equity side, generally, most of the ETFs we use are cap weighted. And there it's because they're not trying to capture a very specific interest rate exposure or something like that, but they're trying to capture our market. They're trying to capture the growth of the economy. And cap-weighted ETFs are very effective at doing that, very cheap to manage, no tax consequences and the like. The exceptions there are when you are trying to do something different than just capture the market or the economy. For something like a minimum vol ETF, which is meant for a different type of investment objective for more conservative investors. And so that's basically how we think of it.
And different parts of the efficient frontier, right? Did you want to mention that, Robert, as well?
Yes, sure. Different ETFs are appropriate on different points of the efficient frontier. So especially a min-vol ETF, which is trying to actually tilt away from owning everything, the risky stuff, as well as the more conservative things. Things like a conservative investor might actually want to be more focused on the less risky part of the economy. And so something like a min-vol ETF, which is deliberately not cap-weighted, really helps us meet that investment objective.
I think one of the things that Robert did emphasize in his part of his presentation has to do with the essential idea behind the market with frontier is that the securities at the top of the curve should be, by definition of the theory, more risky securities, all other things the same, and at the lower end, less risky securities, all other things the same. It's not just a straight line from one portfolio, the bond portfolio, to the stock portfolio. And so how we think about all of this is really a pretty nuanced idea of what kinds of risks should be represented at the top of the curve, what type of risks should be represented at the top, bottom of the curve and in the middle of the curve. And when you think about the fixed income ETFs, again, there's no such thing as an index fund for a bond index. So it really tries to, what we try to do is think how that should be mixed in terms of how we risk manage the portfolios.
Great, thank you. And then it sounds like so just to look specifically at the fixed income side, it sounds like we have some folks who are curious to hear a little bit more about New Frontier's opinions on the current state of the bond market and rate forecasts, if you guys want to talk a little bit about that.
Well, I think the first thing we would say, Bob, is that we don't forecast interest rates. I think it's, what New Frontier is a different kind of manager. We are basically trying to capture the risk characteristics of global capital markets using the technology that we have that helps us better understand risk-return relationships. So in terms of trying to, so that is what I was trying to say just a moment ago, is that how we think about risk at the lower end of the curve, risk at the higher end of the curve, and how the kinds of fixed income ETFs and, for example, gold ETFs, min-vol ETFs, and so on, how that all mixes in to try to find an optimal solution with respect to the lower and middle of the efficient frontier. So what we do is look at the portfolios. It makes sense to us in some sense in terms of how we understand the risk characteristics of these various securities. And then we try to find, when using our technology, finding a way, finding the solutions that seem to be best in how they have been working together. So we do not forecast interest rates for sure. Did you want to add anything to that, Robert?
Yeah, forecasting interest rates is something that we've been really successful at not doing for a really long time. Everybody has been very tempted to try to say interest rates must go up. But as Dick was saying, this is really about how the portfolio performs and how all the pieces, including exposures to interest rates, fit in. And one thing to keep in mind is that just recently, interest rates have gone up a little bit, and some of the bonds in the portfolios have gone down. But in spite of this, our portfolios with the most bonds are conservative to balanced portfolios. If you're looking at those indices, they are at this very moment at all-time highs. And so the point is the portfolio itself performs well. The portfolio itself is doing exactly what it should be doing, and that continues to be the case is really the most important thing.
And I think the one last thing, Fred, that I would like to add here is that as part of my presentation on the perspectives, you saw that I was thinking hard about what was going on for treasuries and for the Fed and government yields and so on, and of course the whole issue of the U.S. versus the Eurozone versus China, and how to think about fixed income type of risks. And also we chatted a little bit about corporate and junk bonds. So we think, I mean, we can't. This is not a seminar. It's not meant to be that way. But I think what you can see is that we attend to all of these risks, and it's all very much part of how we manage money.
Great, thank you. So I think for the sake of time, that is all that we will cover for Q&A. If you do have any more questions that we didn't get to, please feel free to either follow up with us or we will be reaching out directly to you. So keep an eye out for an email from us. Just a couple quick notes from marketing. So first of all, this is the team that is available to support your work with your clients. We were lucky enough to add Jesse Andrews to our team recently. So he and David Schubach are our boots on the ground and the faces you are most likely to see at events and meetings, while Nick Lamb and myself are available here in the office to answer questions, share marketing materials, any support that you might need remotely. We are happy and here to provide. Dick talked about our indices, so our 6 global ETF indices. You can learn a little bit more about those on our website. You can also find them on Bloomberg, on Yahoo Finance, anywhere that you typically source your index data, which includes your smartphones and smartwatches, where you can track our indices in real time with just the tap of a finger. As always, I encourage you to take advantage of Frontier Advisor, our one-stop advisor resource center, where you can find access to things like marketing materials, portfolio analytics, trade blurbs, and of course, our proposal engine, where you can run custom proposals for your clients using New Frontier portfolios. And those proposals will include both detailed portfolio analytics as well as comprehensive educational material that you can leave with your clients. And finally, I just want to highlight one upcoming event. As Robert alluded to at the beginning of the presentation, October 29th marks the 15-year anniversary of the launch of our flagship ETF portfolios, which makes us one of the longest running, if not the longest running, global ETF strategist available today. So in honor of that 15-year anniversary, we are going to be holding a special webinar on November 14th that will take a really interesting look at how the landscape of ETF investing has evolved over that time. And it'll also give us an opportunity to share some insights gathered from 15 years as an ETF strategist. So I hope that you will be able to join us for that webinar. I think it's going to be a really interesting topic to explore, and you can register for that and also see other upcoming events on the upcoming events page of our website. That is all that we have for you today. So thank you again so much for joining us, and we will see you on the next webinar. Have a great rest of your day.